There's a new mortgage strategy in town, and if you haven't heard about our 10-year mortgage strategy, you won't want to miss this. Let's take a typical 5-year mortgage, and let's assume you're with one of the banks. $300,000 mortgage on a 30-year amortization with a 5-year interest rate today of 3.19, which gives us a payment of $1,292 monthly. And at the end of the 5-year term, we're left with a balance of $267,534. Makes sense so far, right? Now what happens at renewal? Where are interest rates going to be 5 years out? I think it's fair to suggest that they'll be higher than they are today. For this illustration purpose, let's suggest somewhere around 5.5%. Okay, so in years 5 to 10, your carry forward balance of $267,534. Your amortization is now 25 years. Your renewal rate, 5.5%, which allows for a new payment of $1,633. At the end of the 5-year term, your mortgage balance has been reduced to $238,607. Now here's the painful part. Remember that monthly payment? It is increased by $341 overnight due to no proactive mortgage management or interest rate protection. This massive payment shock will happen at renewal, and this will be the unfortunate reality for some, but hopefully not you. Let's have a look at our 10-year strategy. Now this is taking into account our proactive mortgage management services and systems. Let's break it down in the same way we did previous, year 1 to 5. The same $300,000 mortgage. The same 30-year amortization. With today's 10-year rate of 3.89%. Gives us a payment of $1,408 monthly. And at the end of the 5-year term, a balance $262,404. Remember, with us properly managing a mortgage. Now for years 5 to 10, your carry forward balance $262,404. A 25-year amortization, and the same 3.89% rate. Now it's important for a true apples to apples comparison. We must keep the payments the same as in the previous scenario. So your monthly payment here, $1,633. That leaves us with an end of term balance of $210,268. What's more is that we have zero payment shock. When I say we have no payment shock, you're probably looking at the difference in payment from years 1 to 5 and 5 to 10 and thinking, well, of course there's a payment shock. However, because we have proactively managed this mortgage, meaning we have made adjustments and optimized the mortgage through years 1 to 5, so that at the end of year 5, this client is already prepared for a payment of $1,633. And therefore this client has no payment shock for when he or she begins the second 5-year term. So let's quickly review. In the first do-nothing strategy, years 1 to 5 and 5 to 10, we had interest rates of 3.19 and 5.5 respectively. That left us with a payment increase of $341, otherwise known as payment shock, and a mortgage balance of $238,607 at the end of 10 years. Now in our 10-year strategy, with today's 10-year 3.89, because we're properly managing a mortgage, we had zero payment shock. We were able to reduce the balance significantly to $210,268. The savings is a whopping $28,339. What's the break-even point for the 5-year no strategy versus our 10-year strategy? It's an incredible 3.44%. So what's your strategy? Saving money has never been so easy. If you like this strategy and would like to see others like it, give us a shout at 403-242-5547. We look forward to saving you money.